Welcome everyone, David Co Real Estate Group. And this month I brought on a special guest, my good friend, Brett Lightner. Brett, thanks for joining today.
Thanks, Dave. Appreciate it.
Look, man, there's been a lot of news about rates rising, and especially yesterday we had a big moment. The Fed raised rates 0.5 point. I'm curious to kind of get a sense of how that's affecting your world and what's happening with rates. And from Caliber's point of view, where are we with rates and where do you think things are going to go the rest of the year?
That's a good question. We welcome the rate increase by the Fed. We do not welcome inflation. Inflation is the enemy of interest rates. So that's why interest rates has gone up, because of inflation. The Fed is the only tool to cool down inflation. So the Fed raising the rates is actually a positive thing in the sense that will calm down inflation, calm down interest rates. The Fed raised the rates, the Fed rate 0.5% yesterday. That's the first time they've raised it that much in one session in 22 years. And they've even indicated that another 0.5% increase is on the docket, most likely for at least the next 2 or 3. So the mortgage rates are actually welcoming the Fed increase because it should counteract inflation and ultimately bring rates down.
Do you think rates are going to continue to inch up as the year goes on, or do you think we're kind of at the top?
I do. I think rates will continue to go up a bit, but who knows?
Yeah, who knows, right? So let's assume it does, right? If you're a buyer and people got really spoiled with 2%, 3% interest rates for a long time, what are some options that a buyer would have maybe to get their payments down, even with these higher 30-year rates going up?
Yeah, we're using a couple cool tools. First of all, the rates, it's sticker shock for people, these rates. When they hear a rate that starts with a 5 and are used to a 3. When I bought my first house, my rate was over 6. So these rates do not seem that high to me.
Mine was 6.5%.
Yeah, nonetheless, they are higher than they were. And let's just face the reality that they are. So a couple of tools we're using is we're doing what's called a seller paid rate buy down. So if someone's going to buy a house for $1 million, pay $1,020,000 for the house and get a seller credit of $20,000. And you can use that credit to buy yourself a significantly lower rate. A $20,000 increase makes your property tax go up a few bucks a month, but it significantly dropped your monthly payment and interest rate. And another one is ARMs. Adjust for rate mortgages are definitely come back. They're very popular right now. 7-year fixed rate could be as much as about a 1% lower than a 30-year fixed rate. People are like, oh my God, but what happens after 7 years when the rate goes up? Even if it goes up in year 8, year 9, and year 10, the amount that you saved in the first 7 years is still significantly lower than had you taken a 30-year fixed.
Yeah, and more than likely, as rates are going up, they'll probably come back down again in a few years, and there'll be an opportunity to refinance.
That's right. I mean, historically, most homeowners have not kept a mortgage for more than 3 years. In fact, over the last 10 years, it's been less than 1 to 2 years. So get a 7-year fixed, and chances are you're not going to have it for 7 years anyways.
Awesome. All right, Brett. Well, appreciate a couple of quick thoughts there. If anyone's interested in learning more about different ways to navigate this market, feel free to reach out to myself or Brett directly. We're going to put your information in the newsletter here. Brett, thank you so much.
Thanks, David.
All right.